Hey there, welcome to this video. Before I get started, I want to make sure that if you're enjoying the videos on this channel, please do subscribe. Also, if you have any comments, any questions, anything like that, please do leave your comments in the comments area below. Today, what we're going to do is walk through a problem set, and we're going to analyze different financial events and their effect on cash and income. Here are the different financial events that we will be analyzing. And one of the things that I've promised to do on this channel is to make sure that I help you as you learn accounting to learn the thinking process behind it, to learn the logic behind it, because oftentimes the thing that students of accounting struggle with is how to think about this. So what does it mean to affect cash or earnings? We have to think very carefully about what cash means. What does cash mean when we think of it in accounting terms? And what does earnings mean in accounting terms? So when we're talking effect on cash, what we mean is the actual cash account. So when we are looking at a financial event, would cash actually be used in the journal entry? If we're talking about earnings, what we're looking at is the income statement itself and the types of accounts that would go on an income statement are revenue or expense accounts. So if a financial event would impact revenue or expense, then it's going to impact earnings. So let's take a look at the first one here. We have bought $400 worth of supplies for cash. In this particular financial event, the journal entry that we would do is supplies, not supplies expense. Supplies is neither a cash account, and supplies does not go on the income statement. Therefore, it would impact neither of these. Cash, on the other hand, we had already said that if it impacts the cash account, then it will impact cash. Cash, however, does not go on the income statement. It's not a revenue account and it is not an expense account. So the only thing that this will impact is cash. And as you can see on the right hand side, I have it in brackets because we're actually using cash. So the fact that we're crediting it and those brackets kind of go together. The next one, number 2. We have an adjusting entry where we've recorded the use of $200 worth of supplies. So now we've used some of those supplies. So we will credit the supplies account and we're going to debit supplies expense. Supplies is not an expense. It goes, so therefore we're not affecting income with that one. However, supplies expense, we are. So if you notice, we're not impacting cash at this point, but we have brackets around that $200. Why is that? I'm debiting supplies expense. Well, but from a net income, a bottom line perspective, we have revenue and we subtract from it expenses. So this supplies expense is actually reducing our net income. That's why we have brackets around it. Number 3. We sold a product for $2,500 and the customer will pay us later. They're going to pay us on account. So we've not received any cash. We've actually increased our accounts receivable. So we'll debit accounts receivable. We'll credit revenue. The accounts receivable goes on the balance sheet. So it's not affecting cash and it's not affecting the income statement. Revenue is affecting the income statement. Therefore, the only thing that we would show here as affecting either one of these is the revenue, because it will increase our net income. Number 4, we've received $1,000 from the customer for payment on their account. We will impact cash, and we will not be affecting net income. Neither of these accounts go on the income statement. So the only thing we're impacting here is cash. For number 5, we bought $5,000 worth of equipment, all for cash. Cash and equipment are the two accounts that we would use in this journal entry. The only thing we're affecting here is cash, because otherwise neither one of these accounts would go on the income statement. And since we're using cash, we'll show it in brackets. And then lastly, number 6. We have recorded $1,200 worth of depreciation for the truck. Depreciation expense definitely hits the income statement because it's an expense account. Therefore, we're reducing our net income. We'll show it in brackets. Neither one of these is the cash account, so there is no effect for cash. Hopefully, through this problem set and this example, you can see how different financial events can either impact cash or they can impact net income or earnings. And hopefully what you've gained through this is the ability to be able to think through why you would choose one versus the other and how to analyze this and think through it. Thank you so much for listening today. And again, please subscribe if you're enjoying these videos. Please leave comments if you have any kind of feedback or questions for us. And we look forward to talking to you again on another video. Thanks.